Welcome to our podcast on financial planning. I'm Catherine Magaña, a certified financial planner professional. Today we're going to focus on an important topic of financial planning, which is tax planning. Tax planning, we really look at financial situations from a tax perspective. We actually want to find an efficient way of using the tax code and look at financial planning, and they really do go hand in hand together. And so we thought it was important for us today to cover the 2021 Biden tax plan and federal tax proposals. Even though there are several items that we're going to talk about today that aren't even approved yet, we thought it was important to start the conversation and start thinking ahead. So we've collaborated with an enrolled agent and tax strategist, Rachel Ivanovich, with Easy Life Management for today's talk. So thank you for joining us. We're really happy to have you here with us today. So let's go ahead and get started, and maybe we can talk a little bit about kind of some of the income taxes that we may come up in the next, or with these changes. So any thoughts on that?
Thanks, Catherine. Thanks for having me today. It's really great to be here. And honestly, like you said, these are proposals.
Yes.
And tax planning, as you said, is a very important topic. And I believe that a lot of people don't consider this until it's too late. And so, given that these are just proposals, I think it's really important also to differentiate between what has already been enacted and what is potentially coming down the pipeline at us. And as you were saying, it's really hard for us to know, is it going to be next month? Is it going to be 6 months from now? Is it actually going to be retroactive if it actually then does take effect before the end of the year? And so let's just have a conversation kind of about what proposals are on the table.
Sure. No, I would agree. I mean, I think you get a lot of calls. I get a lot of calls, and everybody wants to know what should we be doing now.
Absolutely.
And I think it's important to cover some areas that are critical or we think that might be servicing. One in particular I think that's come up is kind of the child care tax credit. I think that's definitely something that's
absolutely
prevalent.
It's top of mind.
Yeah.
Because the advance payments are starting to roll out this month. It's July of 2021. People are excited, a little extra cash in their pocket. And so we've been chatting with clients about, does it make sense to take the money right now? Or does it make sense? Because these are advance payments, and that's really important to understand, because if you take and receive the payment now, you won't be able to use that to offset tax next spring.
Okay.
And so I think that's a really important factor for people to consider, because you can opt out of receiving the advance payments. And why would you do that? I don't know. Honestly, I think a lot of people want to have the money, and it's going to stimulate the economy, they say, but at the same time, tax planning is what we're here to talk about. And so if you're thinking, so currently, for 2021 only, and this is already law, so we're going to talk about proposed versus actual.
Okay.
And so in the past, the child tax credit, so there are two credits that were kind of on the table here. One is the child and dependent care tax credit, and the other is the actual child tax credit. Okay. And so in the past, the child tax credit was $2,000 per child, and it expired. Basically, you got the tax credit up until the child turned 17. So that's to differentiate between this new enhanced child tax credit that's on the table currently for 2021. And so in the past, you'd get the $2,000 credit, a portion of which was considered refundable. The other portion is non-refundable. So to explain the difference between those two and why it's important to understand why this is a great feature for the enhanced child tax credit, a refundable credit functions like a payment, whereas a non-refundable credit just reduces tax liability. So oftentimes you'll have a tax situation and you're doing planning, and if you're looking at what your tax liability is, that non-refundable credit would reduce your tax to zero, but then the remaining portion of the credit, if it's refundable, you'll actually get a refund. Okay. Yeah. So there are two different kinds. So this new enhanced child tax credit makes it's completely refundable, so it's money in your pocket.
Nice. So definitely good to think about and know, and especially like you said, down the line, if you're planning to do your taxes, and if you've already taken the credit, then you don't want to do it twice.
Absolutely. And so you're looking at the credit, and previously the credit was $2,000 per child. Now the credit is, if your child's under age 6, you're getting $3,600, which is a great benefit. And then also the enhanced child tax credit is $3,000, but it's up until age 17, including age 17. So I think this is a great benefit for families.
So another one that I've heard a lot about and really affects some of the clients that are investing or have properties and investments are there's a long-term capital gains and dividends being taxed at ordinary income with taxable income over $1 million. So that's kind of like a big deal.
It's huge. Yeah,
So-
it's huge. And okay, so just to differentiate, this is proposed.
Correct. Yes.
So, and who knows what's actually going to happen? What I've heard is for individuals whose taxable income or income is under $400,000, there will be no changes.
Correct.
So that's a sigh of relief for a lot of people, a lot of families. But if your income is over $400,000 and if you are approaching that $1 million mark, you definitely want to start thinking, should I start planning ahead? And clearly, a lot of clients have called the office who have they work for a corporation, they receive a large amount of their compensation as stock options. Maybe time to diversify, meet with a financial advisor and really look at, your portfolio and should I sell now?
Well, and some other things I was thinking about is, perhaps between now and the end of the year, if it does come into play, then there's some tax loss harvesting or this other things that maybe there's some losses that you can take. So
absolutely.
That's, some things
so it's definitely a really good time to meet with your financial advisor to look at your portfolio, because as you were saying, this proposed rate they're looking to tax long-term capital gains and qualified dividends as ordinary income. And what that translates into is currently there are 3 long-term capital gain rates or preferential rates. If you hold assets more than a year and a day, then the gains on those assets are taxed at lower rates. So therefore, currently, if you make less than $40,000, which you don't pay anything, there's a 0%. If you are up to, I want to say from 40-ish thousand to 446, if you're single, you'll be paying 15% on those long-term capital gains and your qualified dividends. Over that, it's 20%.
Correct. So it's really if those that make over $1 million that are really going to get dinged on this.
And really need to start planning and or thinking about planning. Because the other thing that they're talking about, they proposed, is bumping the highest tax bracket from 37% up to 39.6%.
That's a big deal.
It is a big deal. So definitely want to look ahead. And, it isn't law yet, but it's hard to say what's going to happen.
Yeah. So another one that comes up a lot is the tax gains at death for unrealized gains. And being above $1 million that you're not going to be taxed.
Yes.
So kind of taking a step back, that once again, this is being proposed, so it's not in effect yet. But currently, if somebody gets an inheritance, then there's a step up in basis, and they can use that step up or the 6-month date of death violation.
So it is really important to look at this because they have put this on the table. It's hard to say if it's actually going to happen, but currently, as you were saying, the step up in basis, they are talking about taking that off the table. So the step up in basis is if you hold assets and you bought it for, I don't know, $5 a stock, and now it's worth $100 when you pass away. Whoever inherits it, their basis or what their investment in it is that date of death value. So they're thinking of taking that off the table, and
which is a big deal.
It's a big deal.
Once again, the new proposal then is if it's over $1 million, then at that point they're going to be taxed.
Correct. And then there are a couple of different proposals that I've heard, and therefore that's why it's really hard to do the planning and to dig into it. And I guess the end of the day, the question is, well, what should I do now? And so, as you mentioned previously, tax loss harvesting and really taking a hard look at your portfolio and looking at what is in there. Is it diversified? And what can I do based on the current law? Because even though they're proposing certain things doesn't necessarily mean it's going to come to fruition. I mean, they've thrown out 1031 exchanges may go away.
Yeah, or I saw that, or over $500,000, right? Which is another big deal because a lot of people have real estate and they're doing 1031 exchanges, and so once again, here we are.
The question is, should I sell? Should I do a 1031? So a 1031, for those of you who aren't familiar, is if you hold rental real estate and you have appreciated property and you sell at a gain, you can buy another rental property, which is like kind. They're sometimes called like kind exchanges. Correct. So it's been a great tax planning tool for those who own real estate.
And a lot of people own real estate,
Yes.
especially real estate's gone up so much in value. And
Absolutely.
so that's a really, really big deal.
Yes.
The other thing that kind of comes to mind with some of these potential proposals are, revisiting maybe life insurance or your estate
Yes.
plans. And,
Absolutely.
so those are some areas I think that can be looked at. So perhaps we can talk a little bit about kind of the estate planning aspect of some of the proposals.
Estate planning is definitely a topic that people should be considering right now, even if the proposals that are currently on the table don't go through. The current lifetime exemption, so every individual has what's called a lifetime exemption, which is $11.7 million. That is current law is it will go down at the end, or what they're saying, the language is it's going to sunset back to pre-Tax Cuts and Jobs Act, which was the end of 2017. So it's supposed to go from 11.7 back down to $5 million. And what's on the table currently is that it'll even go down further to 3.5 million. So definitely looking at different planning tools and
I think one of the things
remainder trusts
and grantor remainder trust,
exactly.
and so one of the things that we often see is the annual gifting. So the $15,000 per donee per year, and if you're married, then you can give obviously 30. So I think those are some things that maybe revisiting.
Those are absolutely huge to consider right now. Is to really look at that $15,000 annual exclusion. There's zero reporting requirements for that, and as you mentioned, you can give it to $15,000 to any one individual. A lot of people should be thinking about 529 accounts, which are a great investment tool. And they are governed by gift tax rules, meaning you can put up to $15,000 per individual per year. You don't have to file a gift tax return for that. So definitely.
529 plans, especially of those that have grandkids or even kids or want to gift money.
Nieces, nephews.
And it grows tax deferred and it comes out tax free if they use it for education.
Exactly.
So definitely some amazing benefits there.
But what I've also heard, and I don't know if this is clearly proposed. I mean, I've heard so many things. But I have heard that large gifts, it may be a good time to be considering larger gifts at this point, because if you look at gift and estate tax planning over the years, you'll have that lifetime exclusion amount, and the gift, or if you make a large gift, if it is over the $15,000 annual exclusion where there is no reporting or requirement, it'll just carve away from your exclusion. But I have heard that those large gifts, that if you give them pre-American Family Plan actually being enacted, you may be grandfathered in under the old rules. So I do think that's something to consider if you're thinking about making a large gift to a family member or a child.
So I know we talked a lot about not the unknowns, and we're getting a lot of questions, and we do think, yes, we want to plan ahead, and I'm a planner, you're a planner. But it is hard. I mean, when we don't have the actual information or know for sure, and a lot of things might get retro or grandfathered, and we don't know. So, and in the past, we've also seen things get approved last minute, and so I think it's just being mindful of what's to come. Are there some things that perhaps you may want to do, maybe, along the way, as things might come down the line, but it's, part of this is, also maybe planning, but then waiting to see what comes
Absolutely.
into play.
And as we all know, there are certain tools that are already in place that you can use. You can plan for Roth conversions. I think it's a case by case situation. Every individual really wants to look at if you have money in an IRA account, is this a good year to do a conversion?
And I absolutely love Roth conversions as well. And once again, it is case by case. But for those that are potentially in some gap years with retirement or collecting Social Security or Medicare and just different things that perhaps you factor that in. And I think it is, but there is potential ways to reduce your, not pay as much in taxes now than later. So.
Yeah, and if your business is having a down year, it might be a good year to consider that as well, to do that conversion in the year when your income's a little bit lower.
So is there anything else that we didn't touch on that maybe
we didn't mention the net investment income tax because that is something that you can plan for. So I do think that working with a tax advisor, a tax strategist, working with your financial advisors, because as we were saying, the long-term capital gains rates currently do have that preferential treatment
Correct.
of the lower rates. But if that does go up to be taxed as ordinary income, you're not only looking at that 39.6%, but you've also got the additional 3.8 net investment income tax to consider. And if you're in a high income state such as California, New York, New Jersey, you may be paying 51% in taxes on capital gain, long-term capital gains, and
that's a big change from from what we're used to.
And if you actually look, that would put the United States as the highest country in the world for long-term capital gains.
Interesting.
So it was very interesting for me to see. So it's hard to say what's going to happen.
Yeah. Well, I thought today we want to talk a little bit about tax planning once again, doing financial plans. It all goes hand in hand. Rachel, thank you for your time today.
Absolutely.
Is there a way that people can contact you if needed? Do you have a phone number or email or anything?
Absolutely. Okay. They can reach out to me, Rachel@elmtax.com, or they can call me at my office, 760-730-1817.
Great. Well, thank you so much for joining us today. We hope you learned something and it was worthwhile for you. So thank you, and you'll hear from us again. Thanks.
Thank you.